We're up 118% for the year. That's mainly driven by Tesla. Today, we want to talk a bit more about the technical aspects of Tesla and why we think the stock has been doing extremely well in the last couple of weeks. Before we go there, though, let's give an update. This is the Not Even Wrong podcast. It's July 7th, 2020. This is Krim Delko. And we have, since yesterday, July 6th, we have added another 13% in performance. The market is down 1%. So for the year now, we are up 118%. The market is down 2%. And therefore, we have an outperformance of 120%. What that means is if we started with $100 on January 1st and the S&P has $100 on January 1st, we are now at $218 and the S&P would be at $98. Now let's talk a little bit about Tesla. So Tesla has had some good news recently. First, there was the delivery report, which was way above street expectations. Then there is a high probability of profitability in the second quarter, which would make Tesla eligible for S&P 500 inclusion. And I think this is one of the main reasons why the stock is outperforming. And I think we can talk about the short squeeze here. And here's why. So if you look at the financial markets, roughly, we have around 30 trillion invested in the S&P 500. So a massive, massive amount of investment is in the S&P 500. And if that money, now those are guesses, and I would have to go back and find more specific data, but I think, something between 25 and 30 billion it's a good guess that is invested in the S&P 500. So if a company gets included in the S&P 500, it gets access to that capital because that capital, by definition, is tracking the S&P 500. For a little bit more elaboration on that, there is active investing and passive investing in the market. Active investing is what we do at Orange Capital Partners. We actually take money and we think about where are we going to invest the money, and we have a certain strategy. The purpose of our fund is to create wealth by investing in technological disruption with large social impact. So we're very active and discreet. We could invest in one company, two companies, and we don't care about what kind of indices there are. We don't benchmark ourselves against indices. The reason I give in the updates, I always give the S&P as a comparison. That's just a comparison, and that's all there is. But we're not compensated by any kind of relative performance to the benchmark or anything like that. Now, a lot of other people, they do the exact opposite. They track an index, and they're either passive or active in a way that they either are completely passive, so they take your money and just invest it in the S&P 500 index, for example. That would be an ETF that you can buy in the market, and that is, it's an AI. It's a robot that literally takes the money and spreads it across the S&P 500 index, and then pays you dividends and things like that, and buys and sells stocks according to the S&P 500 inclusion or exclusion. By the way, the S&P 500 index is an index which is provided by a company called Standard & Poor's. That is a media company based in New York. I think they're based in New York. I'm not sure, but definitely large presence in New York. And their job is to create this index, and that's all they do. There are other companies like MSCI, FTSE 100 stocks in Europe. There is Nikkei in Japan. There is companies in Asia that provide indices for their own local markets. Some companies try to do global markets. MSCI is very successful with that. The idea of an index is to put a pool of stocks together and have them reflect something. The S&P 500 reflects the US economy. There is an index which tracks utilities. There's an index which tracks financials, etc., etc. So passive investors just take the money and put it in an index. Active investors that benchmark themselves are investors that take your money and allocate the money according to an index, but tweak it a little bit. So they try to outperform the index by being a little bit smarter and thinking, for example, well, I think this company will outperform that company, and I think I should allocate a little bit more money here, or I should not even have this other company in my portfolio. And therefore, if they're right, at the end of the year, they will have a better performance than the index. So, how can a manager be short a stock even though he's actually not shorting the stock? A company, investment company that benchmarks themselves can be short a stock by simply benchmarking themselves against an index, but not owning one component of that stock. In fund managers lingo, that is being short the stock. So for example, if you want to be short Tesla, after Tesla is included in the S&P 500 and you're benchmarking yourself against the S&P 500, well, just don't own Tesla. And the S&P 500 will perform with Tesla and deliver a certain performance. And since you're invested in all the other stocks of the S&P 500, but you don't own Tesla, you are, in the lingo of those fund managers, short Tesla. And this is, now we're bridging the gap to today's situation. Now, if you're an S&P 500 manager and you don't own Tesla and you're anticipating that Tesla will be included in the S&P 500, then you have two options. You either buy the stock, so you are exposed to Tesla at the weight that you think it's going to get in the S&P 500, or you decide not to own it, and then you are literally short the stock. And I think, like most people in the market, it's probably not a good idea to not own Tesla and benchmark yourself against the S&P 500, knowing that Tesla will soon be part of the S&P 500, simply because, given the fundamentals of Tesla, it's very highly likely that Tesla will do well. And now, if you're a fund manager that wants to own Tesla because you are benchmarking against the S&P 500 and you don't want to be not exposed to Tesla and therefore lose performance, well, you have to start buying Tesla. And this is the short squeeze. And the short squeeze literally happens in a sense that, when the stock goes from 1,200 to 1,300, that doesn't mean that all the shares of Tesla are all of a sudden being sold at 1,300. It just means that a certain amount of shares needs to be bought by a certain amount of fund managers, and whatever is available for sale, a small fraction of the total share count of Tesla, nevertheless, that small fraction sets the price for all the other shares, and therefore the market cap of Tesla goes up. Now let's talk a little bit about numbers here. So Tesla's market cap is about $270 billion, which would put Tesla in the top sort of 15 of the S&P 500. So there's only roughly 15 companies in that club of as or higher than Tesla in market cap. So that's a big number, in a sense that, you have 500 companies and Tesla's already in the top 15 of these companies. And given the growth of Tesla, it's very highly likely that soon they will get to the top 10 and then go closer to the elite club of companies. Those are the companies, the Googles, the Amazons, the Apples, the $1 trillion companies. Now, I'm not saying Tesla will get there anytime soon, but I'm suggesting that there's a very high likelihood that Tesla, given its growth, will get to levels where you as a fund manager, you just can't afford not to own it. Imagine if you had not owned Amazon in the last 5 years and you're benchmarking yourself against the S&P 500, you would have underperformed the S&P 500 dramatically. And when I say dramatically in those benchmarking type circles, underperforming by 200-300 basis points is already, that can end your career. So these people are counting basis points, literally. So that therefore they cannot afford to miss out on such really large companies with very good performance. Lastly, I want to share our thoughts on the actual fundamentals of Tesla, the way we see it. Given how much the stock has appreciated, I think it warrants a little bit more understanding of what we actually think fundamentally the stock is worth. We're starting with a compound growth rate of between 40 and 50%. So let's say 45%, which is what Elon Musk has stated many times. This is based on volume growth, sales growth, this is based on the fact, like Elon Musk said several times, that Tesla is really a bunch, maybe a dozen startups in its own. So the company is really a conglomerate of a couple of startups, maybe 12 of them, and therefore each one, if they start cumulatively adding to the growth, you can get to these types of numbers. By the way, Tesla has been growing 50% cumulative average annual rate in the last 10 years. So to grow at maybe 45 or 40% is, in the words of Elon Musk, you'd be shocked if he doesn't achieve that. So if we put that number out there, let's say a 45% compound annual growth rate for the next 10 years, I think the current stock level is still unbelievably attractive. So the risk with Tesla is, of course, can they achieve that growth? We believe that it's not a foregone conclusion, but just to end this episode with a quote that Elon Musk today tweeted, which is that the real reason he owns long-term shares in Tesla is because he thinks the capital requirements for his other project, which is to make the globe intraplanetary, the capital requirements in the next 10, 20 years will become very large. So I guess what he means is in 10 to 20 years, the requirements will really become big. Right now, he can still finance it with SpaceX and the business and grow the company. But then in maybe 10, 15, 20 years, he's going to have to invest billions and billions and billions of dollars annually to really make it happen. And therefore, he wants to own Tesla and grow his wealth to the point where he can then afford to invest in immense projects, such as bringing people to Mars and building a colony on Mars and things like that. Now, this sounds all very science fiction-y, but as far as Wall Street is concerned, as far as fund management is concerned, what it means is we have a 10 to 20-year horizon at a compound growth rate of maybe 45% for 10 years, maybe 30% for 20 years. That is a massive growth rate. That is a growth rate which will propel Tesla into the trillions of market cap, and therefore the current market cap, while looking very stretched given the last couple of weeks of performance, in the grand scheme of things still looks like a very attractive investment. Thank you.